It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I am your host. I'm also one of the certified financial planners on the program. And with me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
Hey, there's no question that this week's election is going to have an impact on the economy and on the markets. But what about your financial life? And what are the adjustments that you should be making to your financial plan right now because of this election? We're going to cover that and more on this episode of the Wise Money Show.
Wait, there was an election this week?
It turns out there was.
Okay, I don't know how many more times I can use that joke, but I've liked it all year. All year I've liked it. If you have a question for the program, we'd love to hear from you. You can call or text us 574-222-2000. That's 574-222-2000 online. WiseMoneyShow.com is where you can find us. Submit questions there as well. And then all over social media, wherever you are, we are there as well. Search the Wise Money Show. Golly, there was an election. And just I'm so tired of talking about. We're going to talk about not the election. This is not a political show. This is a show about financial planning and your financial life. And so with the results now known, what lies ahead in the economy, in the markets, and how will that impact your financial life, your financial decisions? There's 6 areas to your financial life. That was true on Monday. It's true today. And so you've got to be making sure that you're aware of where you stand in all 6 areas and the big financial decisions, how they impact each of those 6 areas so you can make decisions that bring synergy to your financial life. Anything you'd add, guys?
No, I think this show, because this is a show about financial planning, today we want to call people back to financial planning. If you haven't been investing the right amount of time in your financial life, and really encourage people to be present in their financial life.
Mm-hmm. Yeah, I mean, we started the year. Guys, we've talked about the election, not hopefully not too much, but a couple times. We started the year saying, well, it's an election year. Is it even safe to invest? Should you be cautious? What's history say? Your feelings might be saying something different, but what's true? And we looked at history with you guys and said, no, the coast is clear. Election years tend to be good years in the stock market. There could be some uncertainty ahead. And typically when the election is, when the results are in, then there's sort of this economic sigh of relief, like, okay, we now know what lies ahead and we can start marching forward. And so if you, just reiterating what Kevin said, if you've been a little tentative, I'm not sure what I should be doing because I'm not sure where we're going. Yeah, no matter how you feel about the elections, feelings lie. And so tune into, well, what should you be doing? What steps should you be taking in your financial life?
Yeah. And, spoiler alert here. I think our message is always that your financial decisions should not be based on what's happening in Washington, D.C.
Yes,
right?
Agreed.
Sure. So as much as, maybe there is that sigh of relief that you were talking about, or we at least know who's going to be governing in the years to come, we don't know necessarily what their policies are going to be. This is not going to be a show about predicting what Donald Trump's going to do compared to what Joe Biden did or anything like that. This is going to be a show to remind you of the timeless principles. And yes, to prepare you mentally and emotionally for whatever the economy, the markets, politics are going to throw at us in the next 4 years.
Yeah, I'm glad you mentioned timeless. And I'm sort of on a kick with this right now, but I mentioned a few weeks ago, if you're a continuous listener and fan of the show, a book we would strongly recommend by Morgan Housel, The Psychology of Money. Well, he wrote a follow-up book to that, and it's basically just a continuation of the same thing, but the title is Same as Ever, and basically taking the principles from Psychology of Money, which was, hey, these are the things that never change. Here's some behaviors that you might be hardwired for that maybe are at odds with great financial choices. And Same as Ever sort of takes it and applies it just to life. So what are the things that never change? And what are the timeless truths? So we're going to apply those to 3 different areas of your finances. And the first is what does the election result mean for the economy? And so tucked in there would be GDP, inflation, and those sorts of things. And how should you approach your financial life in light of, well, where's the economy going to go?
Yeah. When we're talking about something as large as the U.S. economy, though, it can feel very much not personal, right? It becomes personal, though, when we start talking about jobs and just business activity. If you're a business owner, what kind of years might be ahead? What kind of revenue could be happening? Is this going to be a time of growth or stagnation? That's what business owners are often thinking about. If you're an employee of one of those business owners, then you care about, hey, is my job secure? Is my industry expanding or is it contracting? All of those are economic things that become more personal for you in your financial life. Another one would be, the concept of interest rates. Mm-hmm. And what's going to be happening there? Are those going to continue to come back down, or will they actually kind of flatline for a while? That has an impact on your borrowing. So these are economic terms, but you need to be asking yourself, well, what impact does it have in my life personally?
Yeah, and I would just look at what am I focused on financially? What am I trying to achieve? And because if statistics prove out about half the folks are really pumped about what happened on Tuesday and about half the folks are not. And so I'd say, well, take whatever energy you have and put it towards the thing that you're focused on financially. And really, if you said, I'm not sure, what should I focus on? You would expect to hear us say, well, focus on your investment portfolio. That's not where I would start. I would start by making sure my present financial position is right where it needs to be.
Yeah, and so those are the things that if we do stub our toe in the economy, and that's not a prediction, we don't make predictions, but if we do stub our toe, or even if the economy is seemingly okay, but your industry stubs its toe. I mean, that's what we've seen really since COVID. They printed $5 or $6 trillion, threw it in the economy within a matter of weeks, and we've been living this grand experiment ever since. And yes, there were a couple times when GDP was negative 2 consecutive quarters. That's sort of the easy definition of a recession. And yet, what we've really had is these really, really on fire, hot areas in the economy, and some areas that have either been stagnant or have gone cold. And so if that happens to you, or if the entire economy has a cold stretch, you need to be prepared. Mm-hmm. You need to be prepared. Mm-hmm. So what's the blocking and tackling? What are the habits that you should have? An emergency fund. Have a funded emergency fund. That doesn't sound fun. It doesn't sound glamorous, and it's not going to be too exciting. But those dollars aren't there to make you rich. They're there to keep you from going poor. What's your first line of defense if you have a financial hiccup or an interruption in your income?
Yeah, we were just talking about that in case class, and one of the things that financial planning does is link the seemingly unrelated parts of your financial life. So if you said, well, what is my present financial position, my 3 bank account system, my emergency fund, fully funded, what does that have to do with the rest of my financial life? Well, one of the things it has to do with is your home and auto insurance. Because if you said, what do I do right now with home and auto insurance rates going through the roof? It's pretty spectacular how the increases, the companies have been passing along these increases. Well, one of the things, if you're going to change anything related to your insurance, you've got to have an emergency fund so that insurance isn't your first dollar of protection.
Yeah.
And so if you have a fully funded emergency fund, it's not as big of a deal if a company unilaterally comes out and says, oh, by the way, there's also a 1% of the value of your house wind hail deductible. So
that's exactly right. So if an emergency fund is one of the stabilizers in your financial life, it's a safety net, a protection against the unforeseen happening. And the big one is an interruption to your income, right? Mm-hmm. Losing your job, being laid off for some period of time, needing to change employers or maybe even change industries. But the other one that you need to also have control over in your own personal economy is your spending. And this has been, for many Americans, one of the great frustrations when we watch our government spend so much more money than what they actually have to spend. They're borrowing to do it. Don't be that, or don't do that in your own financial life. Having control over your own cash flow and having enough margin and flexibility built in so that you can bounce back when life rocks your boat a bit.
Yeah, that's right. So what are some of the other things in your financial life that you need to be aware of or doing as a result of the election? We've got that and more coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern Time, every Saturday morning, also on podcasts at the same time, also on a couple local radio stations at the same time, which is why the content's broken up the way that it is. And also, it's a talk show, so it tends to be a little bit longer. If you are looking for more direct content, shorter content, something that's just built for YouTube, we've got that too. So make sure you hit that subscribe button. Turn on notifications so you're made aware every time we drop new content. Our Next Wise Step videos air every single day, work day, and so Monday through Friday. And if you like the content, you can like the content. Leave comments below, questions as well. We appreciate it. Alrighty. We can pick it back up with, a little bit more banter there. Interest rates, potentially. Now, secret, YouTube, we're recording this on Thursday. We don't know the Fed's decision. All likelihood is they're going to lower rates again later today. We don't know that, though, for sure, and this
Right.
doesn't air until Saturday. So, all right, we'll pick that up and then sort of meander into
So the
markets.
confusing thing is, so Josh says, well, don't live like that. The government does that, don't live like that. And you say, well, why not? If the government can do it, I can do it. Well, there is one small difference. You can't create
That's right.
your own money.
You don't have
If
a
you
printing
can, if you can create your own money, and and people are happy to fund your lifestyle with debt, then you can. But otherwise, nope, it's not a good idea.
Feel free to have that spontaneously come out when we go. Yeah, that's good. All right, here we go. What should you be focused on in your financial life, especially after the election this week? What decisions do you need to make? What should you be doing in your finances? We're helping with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name's Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com, or all over social media, wherever you're at. We are there as well. Search the Wise Money Show. You might not want to be on social media that much right now. There's so much about the election. And even though we're talking about it right now, this is not politics. We're not talking about the election. We're talking about your finances and what lies ahead now that we know the results of the election. First things first, with the economy, that is so broad. And hopefully inflation stays down, and hopefully interest rates continue to come down. Hopefully the economy is stable and we see nominal GDP growth, all those things. Sorry for the jargon there. But ultimately, that's outside of your control. And could end up being a distraction. Whether you're super excited, like Kevin said, the half of you that are super excited about how things went this week, or the half of you that are really disappointed about how things went this week, I don't think the approach, depending on your feelings, I don't think the approach differs. Within your present financial position, both of you, all of us, need to stay on guard. One of the timeless truths, things that never change from Morgan Housel, I completely agree. Approaching your finances, be pessimistic in the short term, optimistic in the long term. Be pessimistic in the short term means, hey, at any time, you might have a curveball. At any time, you need to be prepared for the economy to go sideways, or an interruption to your income, your job to change, or a major financial expense. Be pessimistic in the short term, but remain optimistic in the long term. Oh yeah, even if we do hit a speed bump, things aren't going to stay that way forever, and I need to be investing and approaching my finances as if, nope, there's going to be brighter days ahead.
Mm-hmm.
Yeah, but the issue with being pessimistic in the short term, don't let your short-term pessimism impact your long-term plan.
Correct.
Because if you say, "Hey, short term, I am not feeling like I watched what the market did the day after the election, and the Dow was up 3.19%, the S&P was up 2.1, all this stuff, and so I'm confident that the market is going to turn around because I don't believe in the valuations of the market." Don't make that kind of a decision with your long-term investment portfolio.
Yeah, that's why if you only heard half of that statement and you resonate with the one that you agree with, be careful. It's the full sentence. Pessimistic in the short term, optimistic in the long term. Right? Because if you're optimistic in the short term, that you gotta be careful, gotta be watchful. That could encourage you to take on more debt than what you can actually sustain and live beyond your means. Could mean, well, I don't need an emergency fund, everything's gonna be fine. And no. Be pessimistic, stay on guard, but don't let that pessimism float over and interrupt your long-term plan. You need to remain optimistic long-term.
Here's one of the places where that plays out in our clients' lives. I'm thinking about those who are in retirement or on the eve of retirement, and they need to maintain a long-term game plan for their investments because we're sure counting on retirement lasting decades for them, right?
Yep.
And if that's the case, then you're going to have costs rising throughout your retirement. You're going to need more money to live off of in the later years than in the early years, even if your lifestyle slows down. Just because life gets more expensive, you might be spending more money on medical costs, that sort of thing. So maintaining a long-term growth plan for your portfolio, even in retirement, is important. And yet, one of the most important principles that we encourage our clients to follow is maintaining the right amount of cash, especially early in retirement. Having enough cash on the sidelines to be able to live, without emotion for at least 2 or 3 years. Sometimes we'd say 4 or 5 years, depending on how conservative someone is in their financial life. But the point is, we have to assume that the market is going to be really ugly in the short term, and you may not want to go to those investments. What if they were temporarily at depressed levels? They're down in value. You're not going to want to sell at that point. So let's not have your lifestyle based on whether the market is good or bad in the short term. Let's have cash on hand that is dependable, predictable, that sort of thing. But don't abandon the long term with your later dollars that you're going to be spending.
I met this week with 2 folks that are retiring right now, and with each of them, we have 3 years worth of cash. We've got a money market that's still paying a decent interest rate. Yeah, it's below 5% now, but it's above 4%, and so we've got 1 year's worth of their income, of their spending, of their supplement to their Social Security. We've got 1 year in that, and then when interest rates were higher, we locked in a 1-year CD and a 2-year CD, so that as they spend through that money market, the CD will replenish that, and then the 2-year CD will replenish that. Right after those 3 years, we've got intermediate term investments in place. We don't need to get into the details, but I'll call them hedges that should help participate if the market delivers positive returns, but have some protections built in if things do get hairy in the short term. And that's what they'll spend right after those 3 years. As these CDs mature, we'll use some of those hedge dollars to buy new CDs or get some lower risk investments. And that way, we've got about 8 years worth. We know exactly where income's going to come from for 8 years. So whether the economy is roaring or the economy stumbles or markets stumble, we've got a good plan in place, because the dollars that they won't need for 8 years or beyond, those are invested in the markets. And that because their job isn't to, root for one side of the aisle or the other, it's to fight inflation over the long term.
Yes.
And so that's how we have things structured. So guys, let's move into what do we think the impact will be on the markets, and what approach should you have? Let's continue that discussion. Kevin, you mentioned, the results on Wednesday. I think we look back, going back to 1928. Those were the best. That was the best day, post-election day, in the markets ever. Now, again, you're either excited by that or you're kind of irritated by that. Markets are forward-looking. They're forward-looking, and we've been through this enough that typically when the election results are in, the market says, okay, well, now we sort of know what to expect. And November and December of election years are the two best months. Looking back at history, are the two best months of an election year because of that clarity. Not because of who wins, but because, well, we now know what to expect.
That concept of the markets being forward-looking, it implies that as new information becomes available, it gets assimilated into investors' decisions on whether they want to be buying or selling. Do they want to be in the market or out of the market? And it's, things like, well, what do we think is going to happen with tax rates or, economic growth policies, that sort of thing? Is this going to be an environment where business thrives or struggles? All of that has an impact on where people think the stock market is going to go. But also in the short term, it is subject to the emotional swings of us as investors.
Yeah.
And I don't know if you guys know this, but we had people literally coming off the street in our Edwardsburg office the day after the election saying, hey, I just want to talk to somebody because I've got money that I need to get invested. We had people calling who I personally know they were out of the market for 4 years straight because there was no way anything good was going to happen under a Biden administration, and they were missing out on some pretty amazing growth in the markets. Day after the election, they're calling saying, I'm ready to get back in. And that's interesting to me, right? Mm-hmm. It's almost, I don't know how you guys interpret that, but in my mind, we voted on Tuesday, and on Wednesday, people were voting again with their dollars. Mm-hmm. They were saying, okay, my guy won, or my team's jersey is going to be hanging in the White House or in Congress. Man, I'm ready to get going again.
Or the opposite.
Or the opposite. That's exactly right.
And you got to be careful. Like, there's a timeless truth there, and we started this year with that. No matter how you feel about politics, stay investing for the long term.
Yeah. Investment years are good for the stock market for the most part, and it's a little bit better if a Democrat is elected than a Republican. And people look at that and they're like, no. And this is the thing. The markets are forward-looking, but what the markets see, I can't see. I looked at what happened in the market on Wednesday, and it didn't make any sense to me. I looked at some of the companies that had a meaningful jump in their share price. If there are any fundamentals that matter, it didn't make any sense.
I mean, but let's not forget, because as investors, we all have amnesia. If it didn't happen yesterday, it probably didn't happen. Nope. Let's go back. When the 2020 election results were in, the market was positive 2% that day. Mm-hmm. When the 2016 election results were in, overnight they had to shut down the futures market because things were crashing. And yet the actual day was positive in the market. Mm-hmm. All right, we've got more coming up on the Wise Money Show with Korhorn Financial Group.
Isn't that crazy?
It's crazy.
How it can get it so wrong so fast, but then reverse itself.
Yeah.
That was quite a phenomenon.
All right.
If you look at some of the stocks that did gap higher, it doesn't. This is what makes me say I don't understand the stock market, which is why I have to be invested in it and not try to invest in a particular piece or part of it.
I saw a few companies that were jumping higher, and they were, some specific steel companies. Companies that had previously benefited from some of Trump's tariffs and kind of global political positions and everything.
But you just don't know. You don't know.
You don't.
No,
but
and this is
that was
thing.
a theme that.
But I looked at some
up.
financial and some banking stocks that jumped higher, and that. So are we assuming that all of the issues are going to be solved?
No.
And then people are saying, well, there's going to be tariffs on China, so dump China, but buy Caterpillar and Tesla, who are totally reliant on China. Mm-hmm. Like, you can't square that circle.
Yeah, you're right.
All right, third segment. We'll pick it back up and see. Well, I'm sure we'll get into taxes as well. So, all righty. So where are we? We're markets. We'll talk about valuations, and we'll talk about but going back to the timeless things, the things that never change. The markets in the short term react with emotion, fear, and greed. In the long term, valuations, earnings. All right, here we go. What adjustments should you be making within your investment portfolio, if any, after the events of this week. We're helping with that and more right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. You can catch up on any. No, we got to reset.
Yes.
I finally did it. I was thinking of where I was going to go, where I was going to take us, and I was like, oh, I've got to say something. There's been a couple where I've missed it.
Yeah. I'm so glad I was here to witness that.
Yeah, there you go. You're welcome.
You made my day.
Now I don't even know what I'm. Kevin, you want to open us?
Third segment.
Third segment.
That would throw everybody.
Yeah. All right. Here we go.
Hey, I'll give it a shot.
How should the events of this week impact your investment decisions? Should you be making any changes or everything stay the course? Well, we're helping with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast. Wherever you listen, search the Wise Money Show. Follow us there. Rate the program there as well. We appreciate it. Okay, we're talking about after the election. How does that impact your financial life? And we first talked at a high level, the overall economy. Always be on guard for an interruption to your income or a recession or some sort of struggle. Maybe don't expect it, don't plan on it, but be on guard. Be ready, right? And that's something that doesn't change. On the investment front, though, in the stock market, we would also encourage you, lean on timeless principles. Mm-hmm. And history is abundantly clear in this regard, that no matter who's in the White House, stocks do well. Stocks do well. And we've looked at the cocktail of, well, if it's, this party White House and split Congress, or if it's fully united or whatever, here's the results. And guess what? Stocks tend to do well. You're going to have strong emotions. You've had them all year. You've had them after the election, and that's fine. But timeless investing truths and financial truths say, set those emotions aside, and whether they're really strong or whether they're really positive or really negative, use that energy to stay the course and stay invested for the long term financially.
That's exactly right. And, rather than us sit here and try to predict what the stock market's going to do next for you, you wouldn't want to listen to it. We would be making something up. Nobody knows the future, but we do know what has recently happened.
Yep.
And one of the principles in your financial life, one of the action items that you need to have baked into the normal rhythms of your financial decision making is periodically reviewing the mix of investments that you have in your long-term portfolio and snapping it back to the right mix, or what we refer to as rebalancing the portfolio. There are some areas in your investments, if you are well diversified, some areas have been booming over the past couple years, some have been growing nicely, some have maybe been stagnant or even down at times. And rebalancing says, I want to go back and trim the areas that have had outsized growth and maybe buy the things that represent bargains today. Sell the stuff that's at a premium, it's at a high price, buy the things that are at a low price. And that naturally happens when you reestablish that target mix of investments that you had set for yourself.
So I like that, Josh, but here's what I'm thinking, because of the folks that have been talking to me. So the folks come out of the woodwork that you haven't heard from in a while. Not necessarily even clients, but just people that know that we're in the business, we handle investments. And I've had a couple of questions from folks that said, listen, I've been sitting in cash because I was worried, and now I'm ready to invest. Mm-hmm. And so to me, it reminds me, it's the opposite of Black Friday. Because Black Friday, why is the mall full at 6 o'clock in the morning or whenever it is on Black Friday? Because prices have gone down. Well, if you go back to when's the last time prices were meaningfully down? It was really September of 2023. Mm-hmm. And there wasn't a lot of optimism going on, and people were looking at their portfolios and were not feeling kind of dour about things. And so now folks are coming and saying, hey, I've got this money. I've tried to do it myself. I had it in cash. Now I'm ready to go. Should I just push it into the market? And the risk is if you push all that money into the market at the all-time highs, your risk is that you're going to continue to ride the roller coaster. Something's going to happen. The market's going to drop 5 or 10%. You're going to look at that size drop and say, I can't stand that. I've got to get back out of the markets. Yep. So if you're listening today and you say, hey, I've got some money that has been sitting on the sidelines, and now that the market's at an all-time high, I really want to get it invested, then what I would encourage you to do is for sure talk to your financial planner, make sure they're certified, and make sure that they can help you with more than just your investments. But think of it, kind of laying that money on its side and getting it invested over the next 18 months instead of over the next 18 days.
Mm-hmm. Because here's another timeless truth in the markets, that the markets have a very, very clear pattern of behavior. Markets reach all-time highs. They do. So don't see that. Don't hear Kevin say reach an all-time high. I'm contrarian. I better watch out. Nope. They hit all-time highs. I think that's the 11th or 12th time we've hit it this year, and I might be lowballing it massively. Okay. Markets hit all-time highs. What do they do after that? They retreat from those all-time highs. It's inevitable. The markets, are volatile. They move up and down. They're forward-looking, so they're assimilating all sorts of information and trying to get it to make sense. They're also moving in the short term based on fear and greed. So what do they do after they retreat from those all-time highs? They go on to reach new all-time highs. That is the pattern of the market. Now, we said earlier, no matter who was going to win the election, it's likely that the new president was going to inherit one of the most expensive stock markets in history, and that does seem to be the case. Yeah, we've got a couple months before inauguration, but if you just look at price to earnings, so what's the price of the stock market compared to the profits? It's typically how a business is valued. What's a business worth? Well, how much does it have in profit? That price to earnings, when you look back historically, this is the second highest level that we've had, the price to earnings ratio, only second to the tech bubble. And in 2000 we had, 99 we had an election, and George W. Bush entered office in 2000. And yeah, that was a bubble. That was claimed a bubble for a reason, because it ended up, the stock market had at the time the worst stock market since the Great Depression following that. And so this is going to be a really challenging situation for whoever was going to win the election. And yet again, the stock market doesn't change that much depending on who's in the Oval Office. What really drives the markets long term? If short term it's fear and greed, long term it's earnings. Long terms are earnings growing. And over the past year, they've grown about 8%. That's average. Well, the stock market's up double digits, over 20%. Mm-hmm. So the year before, Kevin, you said a year ago, that's when things were recently kind of stinky. Yeah, that's true. So the stock market over the previous year didn't have a lot of gains, even though earnings grew about 8% as well. So are we making up for lost time, or are we borrowing some of the future growth and have already experienced it? We don't know.
And that's why we want to have a plan, because I can't tell you how many times I've heard, hey, this next 10 years, this next decade is going to kind of be a lost decade, or you're going to have low single-digit returns, and Warren Buffett is selling his stocks, so therefore you should too, and everything else. And over the last 10 years, from 2014 to 23, the S&P 500 is up basically 12% per year.
Yeah, fantastic.
And it has to do that because the money, as the money supply grows at 8% a year. So you say, well, what's the bogey that I have to beat? Is it inflation, or is it the money supply? Because I would argue that you probably need to beat the money supply, and the only shot you have at having any kind of an 8% compound annual growth rate is to be invested in assets. And you say, well, what assets should I invest in? And this is where we say, well, probably the best companies in the world.
Yeah,
that's what you should have some pretty decent exposure to.
Businesses that are producing goods and services that people need and really crave, right?
Mm-hmm, mm-hmm.
Those are the businesses that are going to be profitable, and those are the assets that you would want to own, because they're going to do well as just life continues, as we as consumers continue to need and use those types of products. It's the reason why, in my opinion, one of the most important or best attributes of the most successful investors It's not how well you can predict what the economy is going to do next. It's not how well you can slice and dice financial statements and find the diamond in the rough or anything. It is optimism. It's a character quality. It's a view of the world. And so I think it's important. We should probably be restating that Morgan Housel quote over and over in this show. You should be pessimistic in the short term, optimistic in the long term.
Yep. And where do you invest? You invest for the long term. Right? You're not investing for the short term, because the stock market over the long term, my favorite chart in investing is, on average, how's the stock market perform after one day? It's about 50-50. What about 1 month? Better. What about each quarter? Better still. What about over a year? Almost 75% of all years are positive. What about over 3 years, 5 years, 10 years? The longer you go, the better your chances are. Therefore, investments are long-term. We've got more coming up on the Wise Money Show with Korhorn Financial Group. The stock market's long-term. Said investments are long-term.
Yeah, but if I'm pessimistic short-term, I'm getting my present financial position dialed in.
Yep.
And if I'm optimistic long-term, I'm exposing myself to assets.
Now, this next category is taxes, and there's nothing to be optimistic about there. It's all pessimistic, short-term and long-term.
I'm optimistic that they're going to be around.
Yeah. All right. So probably not getting into any questions or whatever. So we can talk about tax planning and whatnot. But
yeah, anywhere in someone's financial life that there are action items that they can be reminded of. Yep. As Kevin said, kind of calling them back to the behaviors or the approach for their financial life.
I'm assuming it's coming, but I was surprised to hear you guys say that on Wednesday there was that sort of outcry of people that had been on the sidelines that are now ready to go. Yeah, that's a shame. Don't let that be you.
But I know, but that is, that's all the stuff that we've ever read.
Yeah.
That just confirms that if you are breathing oxygen or you can hear this, you're hardwired to be a horrible investor.
Yeah.
Like, get that money in now that it's at the top. Because, again, it's the exact opposite. Like, how can I be hardwired to be a horrible investor, yet hardwired to be an excellent shopper? It almost doesn't make any sense to me.
All right, fourth segment, land on the plane. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show, as well as a lot of other content, is on the YouTube channel. Go to YouTube, search the Wise Money Show, subscribe to it there, turn on notifications so you're aware every time we drop new content. You can share the content as well. You can leave questions there, all that sort of stuff. So these talk shows, yep, they're all there going back seasons and seasons, but we've got Next Wise Step videos that air all throughout the work week, taking one financial concept, applying it directly to your financial life. Interest rates, inflation, Roth conversions, tax planning strategies, all of that. Lots of content, well over 1,000 videos. Go to YouTube, search the Wise Money Show, subscribe to it there. All right, Roth conversions. Guys, we're going to take it to the last sort of angle of after the results this week. We've talked about, well, what do we think, where could the economy go and what should you do to prepare? What's going to happen in the markets? How should you be prepared? What are the results this week tell us about taxes?
One of the things that we've been talking about all year was, reminding everyone who listens, don't lose sight of the tax laws that exist today and how they were put in place temporarily. And many of them were set to be expiring at the end of 2025, right? And that was all based on the assumption that nothing changes in Congress or that they just allow what was written to continue to play out. And now the question is, okay, with the White House and Congress all, on the same team, so to speak, is it possible that those laws are extended or they're replaced with something as good or maybe even better from a tax standpoint? That's exactly what people are always watching at the turning points with an election is, whose policies are going to prevail moving forward.
And isn't it because we heard a really intelligent individual once say that Congress can change tax laws, and they do frequently because they don't need a supermajority or something like that, right?
Yep.
So, and we're all, getting the brunt of that. Like, there have been so many tax law changes, it's hard to keep it all straight. A lot of CPAs and tax preparers have checked out. Like, this is... the rules keep changing. I'm done with this chaos. We might see some more of that. I do think, we've said it before as well, that the election was basically going to determine the fate of the current tax laws. Mm-hmm. And but now, with all the campaign promises, if you want to call them that, right? I wouldn't. But on the campaign trail, there's lots of tax policy being discussed. And so if you're going to try to implement any of those things, it's probably not an extension of Tax Cut and Jobs Act, but probably a redo. Mm-hmm. We'll see.
Yeah. So one of the timeless truths is that if you reduce taxes or reduce the tax burden, the revenue to the Treasury increases. And it's a little bit you'd think, well, that can't be true. But if you look back and study it, every time tax cuts have been implemented, the revenue to the Treasury increases. So this is where I don't know what's going to happen. And when you look at that and you say, well, do I get excited about tax cuts? I do, because that means more money stays in the pockets of hardworking Americans. I don't get excited, and people are like, well, if that's less revenue in the Treasury, that's not good. But the reality is, if for every dollar that goes into the Treasury, we spend $1.20, it almost, and I'm an optimist, but it's hard to be optimistic when you watch that. And the question is, now that the Republicans hold the presidency and the House and the Senate, will there be the political will that they've never had to be fiscally responsible?
Yeah, I'm not going to share my opinion on that, but I have a sense. So,
well, right. And if you look back at history and project it forward, you'd say, well, no.
That's my sense.
Yeah.
Yeah, just based on history.
I know.
And but as we connect that to taxes, I don't think this changes anything. You need to be planning ahead for your taxes. I think there are greater odds that tax rates don't go up. And I don't think they let the Tax Cut and Jobs Act sunset. They either extend it or they change it. But I think there's greater odds of that. But you don't know for sure. You need to plan ahead. Now, there's 3 specific tax campaign discussions that have been floating around. I just want to touch on each of them. One, the corporate tax rate going from 21% down to 15%. Wow, that'd be pretty huge for C corporations, public corporations. That would be pretty huge. Could actually have a pretty big economic impact.
Or on your portfolio, because if you are an owner of those corporations, because you've got mutual funds that own stocks, or you maybe have purchased some individual stocks in your portfolio, if all of a sudden one of their major expense lines shrinks, and I'm talking about taxes, then it means that they are naturally more profitable, or there's more dollars to potentially be paid out to investors, more money to be investing into great projects that expand the corporation, that sort of thing. So being an investor is really important. This is one of the ways that you benefit regardless of who's in the White House.
Yep. The other was a thing that I personally get it's a nerve for me, the taxation of Social Security. We've done lots of discussions on this. It's very, very complicated. They promised they'd never tax it. You're paying into it with after-tax dollars, and yet they do tax it. And they've taxed it in a way where each year, as there's inflation and so on, the taxation of Social Security gets worse and worse. Now, one of the campaign trail comments was, we're going to stop taxing Social Security. I don't buy that. I think that's going to be very difficult for them to pull off. If they do, fantastic. And then I go back to the fiscal conservative and how does that work from revenue and expenses for our government. But I think that'd be great. I'm not holding my breath.
I know, but here's the thing. Even if they stop taxing it, what is the cruelest tax of all?
Inflation.
Mm-hmm. Right. So this is the thing. If we don't do anything about inflation, and I would say inflation is a government policy phenomenon.
Yeah.
So if we don't deal with inflation, it doesn't really matter what happens to the taxes.
And then the last one, and both camps were campaigning on this, and that was not taxing tips. Now we are at a very strange point in the world with tips. We were just talking before we got on the air. Both Josh and I were recently at restaurants that are basically self-serve. You just order from a counter and then you retrieve your own food. And yeah, they're asking for tips. This is strange. It's very strange.
Before you can pay. Like you put your card in and it says select the tip before you can actually check out.
Before any work has been done or anything. It's kind of silly. So we've gotten out of control there.
So yeah, like the logic behind it it seems to be missing. And I actually wonder.
But there is no logic there though, right? I mean, that is, in my opinion, it's campaign talk that is targeting certain groups of voters. We need voters, young voters, to come out and support our campaign. So let's talk about some things that apply to those young voters, like tips. Or we need more seniors coming out to support our campaign. Let's talk about not taxing Social Security because that will resonate with them, right? That's what it was driving.
I know.
Now that the election is over, when we start hearing the debates that are happening in Congress and seeing, well, what really are the priorities that they're going to focus on, that's when new tax laws or indicators are going to start coming out. But it almost doesn't matter what new tax laws are happening. You need to have a game plan for your financial life that includes tax planning. Regardless of how the rule book is going to change, you have to be ready for it. And it needs to be, as we always say, part of the normal rhythm of your financial decision making. Every year you need to be revisiting this stuff.
And it does illustrate how absurd this last election cycle was, because I think, okay, they're talking about do we tax tips or do we not tax tips? Hey, guess what? If people get cash tips, can I tell you how much tax they pay on those?
Yeah.
Number one, and so, right, and so number two, it felt like the student government election where I was promising I was going to put root beer in all of the drinking fountains, and I realized,
awesome.
That didn't work.
So here's the thing, guys. No matter how you feel about the results this week or not, there's timeless truths in your finances that need to be applied. There's 6 areas to your financial life. You need to do proactive planning in each of those and see how the big financial decisions that either you're making or that lie ahead, how are they going to impact those 6 areas? You need to be working with a CFP, Certified Financial Planner, doing comprehensive financial planning, looking at all 6 of those areas and planning ahead. Staying the course, pessimistic short-term, optimistic long-term, tax planning, and making sure that you've got the right emergency fund and the right investment strategies. Work with your CFP on that. That's all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, all of us at KFG, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.